Blackstone, the largest alternative asset manager in the world, just raised $30 billion for a global real estate drawdown fund. So in other words, a fund that is designed to be opportunistic as prices of certain assets come down. And they have been very clear that they are looking for certain opportunities to start to come available in specific sectors of the real estate market. And this comes on the heels of credit markets tightening and certain big players in the real estate industry, specifically in the commercial sector, defaulting on commercial mortgages. And that leads to multiple questions about exactly what type of investments Blackstone is trying to make, and more specifically, are they coming for your home or the home next door? But before I get into all the details, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit the subscribe button so more people like you can see this video. It really does help a lot with respect to the YouTube algorithm and helps me continue to make videos like this for you. Okay, so let's start first and foremost by discussing who Blackstone is. They describe themselves on their website as the world's largest alternative asset manager with over $975 billion. Yes, that's just $25 million short of $1 trillion in assets under management, and over $577 billion in global real estate. And that without question makes them one of the biggest real estate investors in the world. Now, recently there was some concern as investors started to withdraw funds from one of their real estate investment trusts, but that did not stop Blackstone from going ahead and continuing to raise money for opportunistic plays in the real estate world. And this was the big headline this week. Blackstone raises more than $30 billion for giant real estate fund. And this specific fund is being called Blackstone Real Estate Partners X. Now, X isn't something that's devious in any way, shape, or form. It's just the 10th raise that they've done like this, albeit this is the single biggest raise they have ever done. And they're billing this as a property drawdown fund. So it is very clear that they're looking for real estate values to come down in certain sectors. And the sectors that they're looking in are specifically rental housing, hospitality, and data centers. Now, this doesn't mean that they won't be taking advantage of other opportunities as they come up, but this seems to be the area in which they are looking. Now, over the last couple of years, there's been a bifurcation of the real estate industry. Obviously, office spaces are no longer the great investment that they once were. Post-pandemic, less people are going to the office, and we're certainly seeing lots of companies that were heavily invested in that space start to default on their mortgages. As an example, just this week, Brookfield defaulted on $161 million worth of mortgage debt as they struggled to find tenants for many of their offices. And as a result, the commercial real estate sector, at least with respect to office space, is struggling. And this means that values in that sector are starting to come down. However, this isn't the type of real estate that Blackstone is looking at. No, they're looking at sectors that are well positioned for the current economy. And that includes things like logistics. Obviously, that has been a major play given the fact that people are starting to shop online more often. They're looking at rental housing, specifically it seems around student accommodation, and obviously purpose-built rentals. And they're looking at the hospitality industry, which Blackstone is no stranger to. In fact, in 2014, Blackstone purchased the Cosmopolitan Hotel in Vegas for $1.7 billion. And this is as Las Vegas casinos had struggled for years after the financial crisis in 2008. Now, as an aside here, Blackstone just recently sold the Cosmopolitan Hotel for almost a 3 times return on investment. And while I was in the process of researching this video, I dug really deep into some of Blackstone's pitch decks, finding, for example, this slide, which talked about Blackstone's proven ability to source and execute transactions in scale during moments of volatility. And that is exactly what they are looking for here, is moments of volatility where companies are maybe trading for less than they should, and Blackstone is able to swoop in and purchase properties at a discount or purchase entire real estate portfolios at a discount as they have in the past. And if you take a look at this graph, you can see that many of their acquisitions have come at times of high stock market volatility. Obviously, here's the previously mentioned Cosmopolitan purchase. They purchased the Gramercy Property Trust, which owned a significant amount of some of the most expensive real estate in the world. And most recently, they purchased Crown Resorts as it became clear that the hospitality industry is going to be a very good place to invest money. Now, back in 2021, there was a lot of controversy surrounding Blackstone and their pursuit of real estate and specifically single-family homes. This was because they purchased for $6 billion a company called Home Partners America. And this was a company that purchased single-family homes in order to rent them out. Now, as far as I can tell, Home Partners of America only has about 17,000 homes, which is a drop in the bucket compared to the number of single-family homes that are available in the US housing market. But Blackstone and Home Partners America have also scaled back their buying. And this is partially because some markets have become too expensive, and it's also because some cities have made it hard for companies like Blackstone to purchase real estate. which in the long run is probably a good thing for consumers. And when you take a look at the fact that there's over $975 billion under management with Blackstone, the $6 billion worth of real estate that Home Partners America owns is a very small drop in the bucket for a very large organization. And it is clearly not their focus, because owning single-family homes for a large organization like Blackstone is probably more of a headache than a good investment. And my guess is that just like the Cosmopolitan, Home Partners America is probably something that Blackstone is going to offload in the next 3 to 5 years once they're able to get a decent return on their investment. So even though Blackstone has raised $30 billion to purchase real estate, the reality is they're probably not coming to purchase your home or the home next door. They are likely to purchase, however, multifamily properties that house hundreds of families at a time, or the companies more specifically that own them. And in that case, it's more of a transfer of who the landlord will be rather than a single organization coming in and propping up real estate values in any particular market. So while it's very much clear that Blackstone believes that they're going to have the opportunity to buy real estate assets for very cheap in the coming future, they almost certainly are not coming for your home, and there's probably not much to be worried about. But as a real estate investor, there's some really cool lessons to be learned here, and the most obvious one is that paying attention to specific sectors of a market that are poised to do very, very well and looking ahead is the first step in making really great real estate investments. So the question is, if you had a real estate drawdown fund, what would you be investing in? And if you want to learn more about real estate investments, make sure you check out one of these videos right here.